This is a chart of Laurus Labs, and this is 3rd of April 2025. So this chart is more than 3 months old, so we are allowed to discuss this chart as per the SEBI regulations. I wanted to discuss this chart with you because I had rejected this stock. It is very important to learn how and why to reject a stock and then check what happened after you had rejected the stock. It's very important to do that so that you understand the effectiveness of your decisions. Rejection of stocks is more important than selection of stocks because eventually, as you continue to reject stocks every day, you will find a stock which you simply cannot reject because the characteristics of the stocks are so good that you don't find a reason to reject a stock. That is a stock that you should be taking a position in. This is Laurus Labs daily time frame. I have drawn this base for you. You can see it's a volatile base. It's a deep base. So if you measure the distance from point number 1 to point number, not very deep. This is a B grade base. Okay. Volatility is one reason. Uh, I felt that this stock had more risk. Another reason I felt the stock had more risk was because this was a swing trade. This was not a positional trade. I remember looking at the fundamentals of the company. I did not find them convincing at that time. I'm not talking about today because by now the next quarter earnings have been released, but at that time, I did not find it convincing. Another thing I remember is I think the industry group rank for this stock was more than 40, less than 100. So it did show up in my filtered list, but there was no improvement in industry group rank. So you understand, I am looking at risk factors. First I looked at volatility in this stock. I don't like such huge candles, stock falling 9% in a single day. That's volatility. Second risk factor was this was a swing trade, not a positional trade. Third, industry group rank was poor. What about green zone closing? So let me measure the points for you. So this is point 1, point 2, point 3, and point 4. 4 points in the base, buy point in the green zone. So let's draw a yellow line here. This is 628. So 628. So that was the buy point. What is the distance between closing and buy point? Let's see. 3.14. So it is less than 5%. So it's a decent technical trade setup. What about closings inside the green zone? You go here, you click on bar chart. You see 1, 2, 3, 4, 5 green zone closings. Fantastic. Okay, so technically it looks good. I must have rejected it for comparative reasons. If you look at the industry of this company, let's go there. By the way, let's look at market conditions. This was 3rd of April, right? So between 18 March and 7th April, the market was in a confirmed uptrend. Then it went into a confirmed downtrend. Now, yesterday I made a video in which I spoke about market conditions and how to anticipate this change in market conditions way before MarketSmith actually does it. I explained to you that process. So probably at the time, I don't remember because this is 3 months ago, probably at the time, I was already getting a sense that this market is weak. Just because MarketSmith marks it at a confirmed uptrend does not mean that the market is really in a confirmed uptrend. I am checking how many stocks show up in my list on a daily basis. So if that was declining, probably that could have been another reason why I did not take the Laurus Labs trade. And you will understand why I am discussing this trade because the price action after that was extremely volatile and extremely bearish, the stop loss would have been hit in less than a day, right? That is why I am discussing this stock. Another reason why I'm discussing this stock is because at the time the relative strength of the stock was 87. And if you read William O'Neill's book, he says that the average relative strength of all the leading stocks of the past have has been 87. So just because the relative strength of a stock is 87 or more does not mean that you have to buy the stock. You have to look at comparatives. Basically, you have to do liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis, and then take a decision. So if you see, if I had taken a trade on this day, look what would have happened in the next 3 days. Okay. One, two, three, gone. The stock is near the low of the base. Okay. This day would have kicked you out of the trade. If you had, even if you had put the stop loss at 8%, you would have been kicked out of the trade. If you had put the stop loss at point number four, if point number four, you would have been kicked out of the trade. And look at this high volume fake out candle. So this is high volume and the stock closing below the yellow line. I have explained this to you earlier that when you are looking for a breakout, look for price and volume confirmation. In this, you got on this day, you got volume confirmation. The volume on this day was 3.74 million. Look here. Okay. It was 3.74 million and the average was 3.27. So it was high volume, not very high. We could consider it average because it is just at the blue line. So average volume. So we don't have volume confirmation. Price confirmation we don't have because price has closed below yellow line. So even if I had taken the trade there, I would have reduced my position size by 50% because of no price confirmation and another 50% because there is no volume coming in. As per William O'Neill's book, the volume should be at least 50 to 100% more than the average daily volume. Sorry, average weekly volume. He talks about the weekly chart, but I apply the same concept to the daily time frame chart. The volume should be at least 50 to 100% more than the average daily volume. In this case, it was not. So no volume confirmation, no price confirmation. Even if I had bought the stock, I would have sold 50% because of no price confirmation. I would have sold another 50% of the remaining 50% because of no volume confirmation. So I would have ended up selling 75 out of every 100 shares I would have bought on that day. And that would have uh, helped me avoid this catastrophe. Okay, if I don't manage the trade properly, I will lose money. So first of all, there was no reason to take this trade. Number one, I already had a sense that the market was going into a downtrend. 3 days after this uh, breakout attempt, the market went into a downtrend. So I probably 1 month ago or like 15 days ago, I get a sense of what is happening in the market before even Market Smith changes the status. And I explained that process in yesterday's video. So one reason to reject this stock was probably I was getting a sense that this is not the market to be taking good long positions in. Number two, this was a swing trade. Number three, the base was volatile. Although it was not a C grade or a D grade base, but I felt that the base was volatile. Those were the primary reasons. Industry group rank was also another reason. I still remember it was more than 40, less than 100, and it was not improving. Another reason I could recall is market leadership. This is very important. So the Laurus Labs belongs to a medical diversified industry group rank. So this is medical diversified. If I open this, see, no, this is media diversified. We want medical diversified. This medical diversified. Yeah, see, Laurus Labs number 5. Generally, if it is in the top 5, I consider that as a market leader. Top 5 in terms of market capitalization. Okay, I just simplify it. That is not the correct definition of market leader. You don't have to look at it from the point of view of market capitalization. The definition of market leadership is given in William O'Neill's book. But just to simplify things, I just look at the top 5 stocks by market cap in a particular industry because they are the ones that move the sector. So as long as it is in top five, I don't have a problem. But when the market itself is weak, I'm looking for top three at least, or the best stock in the industry by market capitalization. So this could have been another reason I was not excited about the stock. Technically, the setup was good. So overall, if I have to summarize what happened with this situation was, before this day when I was here, I was looking at liquidity analysis. Everything looked fine to me, no problem. I was looking at technical analysis. Everything looked fine to me. The stock was showing good strength in the green zone. I was looking at comparatives. I found that the leadership is not there. I also found that industry group rank was not convincing. Plus, I also found that the relative strength line, the blue line, which compares the performance of the stock with Nifty, it was in a declining slope. There was no blue dot. That means the line was not near the 52-week high. So in comparatives, I was looking at these things. Market conditions, the market was looking weak. So that was another reason I decided to stay away from the stock. Then fundamentals, the stock did not have good fundamentals at that time. I remember that 3 months ago, it's difficult to remember what I was thinking 3 months ago. I wish I had documented this stock, but I have not done that. So I'm just recalling this from off the top of my head. By looking at the stock, I at least know that I did not buy the stock. Okay. So it's very important to reject the stock and see what happened after that. And that's the reason why I wanted to discuss this stock with you. Market Smith had clearly marked this as base number two, a beautiful cup with handle. If you notice on Market Smith weekly time frame chart, which I cannot show you because of SEBI regulations, they had marked a beautiful cup with handle. So there is another lesson for you here. Just because Market Smith marks it as a beautiful looking cup with handle doesn't mean you have to take a trade. Just because Market Smith says relative strength 87 doesn't mean you have to take a trade. Just because Market Smith says confirmed uptrend on market condition doesn't mean you have to take a trade. This is a simple example I have given you, which turned out to be a complete disaster. If you had followed William O'Neill's book, this would have been a trade which would have resulted in a stop loss. But by the way, this stock does not meet the entire William O'Neill criteria. O'Neill only used to look at fundamentally great companies and comparatively great companies. This stock does not meet that criteria. So it's not just about the charts or technicals or the pattern or the pivot point. You have to do liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. That is why I created that orange trading system to help you take an informed decision. Thank you so much.